As crypto is growing, we see more and more interdependencies between the activity on the blockchain and the activity in Wall Street. Everybody talks about how Wall Street impacts crypto, as in Wall Street is buying Bitcoin and Ethereum through the ETFs and through the treasury companies. But nobody talks about the impact that crypto might have on Wall Street. Now, I saw an interesting short, and I want to share the short here in this video, and I want to discuss whether or not the things that I mentioned there actually make sense. So have a look at this. This comes from the All In podcast. This is a podcast where leading tech entrepreneurs in the US discuss future trends.
Why is gold up? Gold is up because there are many more net new buyers. Who is the most important net new buyer? It's Tether. Tether has been issuing a stable coin called Tether Gold, where they'll actually custody the gold on your behalf, and volumes of it are rising. At the same time, central banks are rebalancing. And then yet at the same time, you have a lot of macro funds that have essentially decided that central banks aren't to be trusted and they don't know what to do. And so they're not necessarily long bonds, and they're not necessarily long currencies, and so they're long gold. So I think it's a mixture of things. There's no panacea explanation. But if you had to put it into a couple buckets, it's net new speculation, net new stablecoin related issuance, and a loss of confidence in central bank policy around the world.
Now that's an interesting statement. Tether being the largest purchaser of gold, pushing up the gold price. So suddenly we see impact from crypto towards traditional finance. But is this actually true? Is Tether that strong of a buyer? What we see over here, that's the gold price relative to the US money supply, relative to USM2. So this is essentially the gold price had we no monetary debasement. So if there was a stable money US dollar supply, that's how the gold price moved over time. The dotted line here, that's the average price among this entire data series, which starts in 1959. This here is the Nixon shock, where then foreign banks were not able anymore to exchange their reserves directly for a fixed amount of gold. So that was essentially a default on the gold promise. So many people just bought gold directly. That's when gold relative to the monetary base appreciated by almost 800%. Then came the tech boom, where everybody wanted to get risk on, and then gold underperformed the monetary base by 90%. Then came the dot-com bubble crash. Again, people wanted to get more risk off. Gold outperformed the monetary base by almost 300%. Another subsequent retracement, now again a run-up, because nobody wants to hold treasuries anymore. Relative to the historical average price, gold is now overvalued by 57%. And barely have we seen a price above the current level. This is a resistance line that connects those three tops. It's not perfectly parallel. People tend to take profit a bit earlier. If we do include a parallel line, then there's maybe still a little bit more room to grow. But really, historically, we haven't seen many years where gold was more expensive relative to the monetary base. And so is this recent rally driven by crypto? Is it driven by Tether and by Paxos? Let's have a look. Here we've got Tether Gold. Here's the market cap of Tether Gold at 1 billion. Here we've got Pax Gold, and this is the market cap of Pax Gold over time. The tokens are mainly on Ethereum. So this is the Ethereum contract with 12,500 holders. Here is the Pax G. The tokens are mainly on Ethereum. There's also ported versions on other blockchains, but it's mainly on Ethereum. This is Tether Gold with 12,500 holders. And here is Paxos Gold with 57,400 holders. And so yes, it is true that there is demand for tokenized gold. On the left side, we see the number of wallets that have at least one Tether Gold. So at the current price, that's roughly $4,000 worth of gold. This is what I'd consider the retail investor that simply allocates towards that asset. There are now more than 2,000 such investors. In the middle, we've got at least 10 tokens. So that's now $40,000 worth of the token. There's still 600 such investors. On the right side, it's 100 gold tokens, or should we rather say tokenized ounces of gold. There are 90 wallets that hold $400,000 worth of gold with Tether. Let's have a look at Pax G, because here the number of total holders is much higher. here are the charts. The number of retail investors is definitely way higher. So here we've got 10,000 wallets with 1 ounce of gold compared to, again, Tether Gold just a bit over 2,000. 10 ounces are held by 2,300 wallets. 100 ounces, so again that's $400,000 worth of the token, is held by 360 individual wallets. So clearly there is demand, and clearly this is a growing industry, and it's growing very rapidly as well. The number of quote-unquote whales grew by roughly 50% year to date. And so again, is this potentially the reason for the recent rally here? Let's put the numbers into perspective. Let's see how much purchases those two issuers have relative to, for example, the central bank buying. Now what we see over here, that's the PEXG market cap divided by the PEXG price, so the number of ounces floating around, divided by 35,274. So that's how many ounces there are in 1 ton of gold. So according to Coin Metrics, PEXG holds 3.5 tons of gold. Here are the same numbers for Tether Gold. They seem to be holding 8.8 tons. If we add both of those issuers, we are at 17.4 tons of gold. Now the numbers are somewhat confusing, because if we are asking AI, then apparently PEXG only owns 0.7 tons, whereas Tether owns 80 tons. So we are talking about a multiple X difference, right? We're talking about 80 tons versus only 17 tons. I'm not sure which number is more reliable. The data that I got comes from Coin Metrics. And so let's work now maybe with the bigger number. Let's say 80 to maybe even 100 tons worth of gold is held by Paxos and is held by Tether. Maybe not all of the gold that's held by those institutions actually is tokenized. How big of a number is that? 100 tons worth of gold. Now it seems like there's roughly 244,000 metric tons of gold in the world. 59,000 of those tons are above the ground reserves, so haven't yet been mined. There's way more gold discovered than has already been mined. Still, 100 tons versus 59,000 tons, that's only 0.17% of the total supply. So yes, the purchases through crypto do have a positive impact on price, but they're definitely not the leading factor of the gold price rally. It's simply just 0.17%. The impact that Wall Street has on crypto is much, much higher. Here's the purchases through the ETFs. It's 2.77% annualized. So that's Bitcoin. Here is Ethereum, 3.5% annualized. And then on top of the Ethereum purchases, we've also got the treasury company purchases. So really, Wall Street might be buying Bitcoin at 5 to 6% per annum, while in the last year, tokenized gold only increased by 7 tons roughly. So that's less than 0.1% of the supply. It really doesn't have much impact on the price. The gold market cap is still more than 10 times the market cap of Bitcoin. So it's not just that the price impact is smaller, also in US dollar terms, Wall Street is buying more Bitcoin and the crypto eco space is buying gold. Really, the main driver of the gold price is central bank buying. Now, Europe wasn't too smart. Europe sold their gold before the rally, but China is pretty smart. China bought more and more together with other leading powers like the US and Russia. Have a look at this. This is the reserves measured in thousands of tons. And this went up by roughly 5,000 tons over the last 10 years. So 500 tons per year. Again, compare this to only 7 tons in the last year through crypto. So while this is an interesting thesis that was presented here in the All In podcast, I have to disagree. I do not think that Tether and the crypto eco space is having any significant impact on gold. Crypto is still the small brother. Crypto does not have significant impact on the rest of finance. The market cap of Bitcoin is very comparable to the market cap of silver right now. And yes, things are changing over time. Tokenized gold is growing very quickly, but it will take many years, potentially even decades, until we see a real impact from the crypto eco space on larger assets such as gold. The gold rally is not driven by speculation from crypto bros. The gold rally is driven by central banks. And central banks buy crypto because they don't like to be invested in treasuries anymore, because of the high debt to GDP in the US, because people are afraid that the monetary base will expand very quickly and that the US wants to inflate its way out of its debt. Now, isn't it fascinating how for most altcoins, the movements to the upside tend to be much, much faster compared to the movements to the downside. We shoot up and then over a long time we trickle down. Here's the example of Dogecoin relative to the others market cap. So when there's news, when there's a lot of attention, the Dogecoin price shoots up within 1 or 2 days to then come back down over several months. We're seeing the same for the Trump token. We shoot up, this was the announcement of the dinner, and then subsequently we come back down. There is a difference though between Dogecoin and the Trump token once we zoom out. So again, this is Trump relative to the others market cap. So the market cap of all of these smaller altcoins, and here is Dogecoin relative to the others market cap. So while we do have our pump and dumps in both cryptocurrencies, the long-term trend is very different, as in Dogecoin just goes with the overall market. It simply just trades in a somewhat constant range, while Trump tends to long-term underperform. And there is a fundamental reason why Trump underperforms long-term, and that is tokenomics. It's new tokens that hit the market over time. Have a look at the following data. This is the number of Trump tokens that get released over time. We started off with 200 million. Now we are at 363 million. So it's the early investors, it's the team, etc. that cashes out over time. And that selling pressure, those vesting unlocks, that dumping on retail, that's what's creating the long-term underperformance. Now, some people say that markets are efficient and that everything is already priced in, but I don't think those charts show that. There is inefficiency, and we can simply turn this around. Let's say we've got Bitcoin relative to the Trump token. Then we're getting this chart here. So since Trump launched, Bitcoin outperformed the Trump token by 560%. This is how I believe we can make money in crypto. It's not trying to find the one outperformer among all those altcoins that always go down. It's doing the exact opposite. It's trying to be allocated in a way that we make money when the insiders and the early investors make money as well. When they are dumping on the average retail investor, we make money because things like Trump tend to underperform long term. As long as the token dilution continues, as long as new tokens hit the market, this chart is very likely going to go up. I'm making money with that strategy already for 4 years. This is a monthly chart. Had I just dollar cost average into Bitcoin, I would have gotten the return here in light gray. Instead, I got the return in black because I also bet on falling prices of various altcoins. It is a mistake just looking at US dollar charts. Really what matters is your portfolio value measured in Bitcoin appreciating over time? If the answer is yes, you're probably doing something right. If the answer is no, then you might just stick with Bitcoin and dollar cost average into Bitcoin and stay away from altcoins altogether. The Trump meme coin is just one out of many examples. Most altcoins have an increasing supply, and so here with Balancer relative to Bitcoin, so we go long Bitcoin, we bet on falling prices of Balancer, we can get this long-term chart. The strategy looks quite straightforward. There are a few caveats though. So for example, here with the Bitcoin to Balancer chart, we do have a lot of volatility along the way. Where does this volatility come from? It comes from small market caps. There is some token manipulation. There is some short squeezing happening along the way. And the smaller the market cap is, the more volatility we invite. So while the strategy is long-term profitable, we have to be aware of the potential pitfalls as well. And so I made dedicated videos on the topic. How can we actually make money from those inflating altcoins? Most altcoins do poorly and we don't have to find the needle in the haystack. The one altcoin that does well, we can just bet on the haystack continuing to go down because, again, the early investors, the VCs, they cash out and they dump on the retail investor. There are two important videos to watch: using perpetual futures on hyperliquid and risk management with relative valuation bets. It's half an hour each, so in total 1 hour of content. And after you've watched that, you know what to do in order to set up positions like this. Now, this here is currently my favorite trade. So this is the position that I will recommend to you once you have joined the premium membership. So you watch those 2 videos, you join the community. Afterwards, I will send you what to do in order to set up this trade. If you don't make money with that trade after holding it for 1 month, then I'll refund you your membership fee. I'm that confident in the strategy that you can simply just open that position, and if you're in the red, I don't want your money. The fee, by the way, is $125 per month. Again, if you don't make money with that trade, I will refund that. But of course, it's a monthly fee. So I share all of my trades in real time with the premium members. So for example, over here, this is where I closed a short position on the movement token. Move was also highly inflationary. We opened this over here where we were at the upper end of the trading range on a relative valuation chart. So we always look at the altcoin relative to the rest of the market. And then when we make quick gains, when we get closer to the lower end, we might also take some profit and wait until we go back again to the upper end of the trading range. I know at the beginning this strategy can be a bit daunting, but again, there is support in the different chats. There's also moderators that can help with any questions you might have. So feel free to check it out. The link is directly over here. Just click on the screen. It will lead you to the premium website. If it's the very first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.